When it comes to reserve currencies and international trade, there is increasing malaise over the dollar's dominance. But what's the alternative? Is it sitting in a vault in New York City?
So the other thing you learn when you go down to the basement of the Federal Reserve Bank of New York is how heavy a bar of gold is. They play a trick on you where you walk over to one loose bar sitting on a table and they say, pick that up, and it's almost impossible for someone of my size to do. Gold is awkward for use in cross-border payments.
If you're facing financial sanctions in the dollar, there's a good chance you'll be facing them in other major currencies as well. So the move into gold is also an expression of that inability to avoid financial sanctions amongst the major reserve currencies.
I'm Barry Eichengreen. I'm a professor of economics and political science at the University of California, Berkeley. I've been in and out of the IMF building off and on over the years, most notably during the Asian financial crisis when I was a senior advisor.
I'm Chima Simpson-Bell. I'm an economist at the IMF and currently in the Africa department where I cover Mali. But previously I was in the statistics department working on balance of payments issues, and it was in that context that I started working on the issues that we'll talk about today.
Eichengreen and Simpson-Bell, along with Serkan Arsenalp, have long studied the dynamics of reserve currencies. Their most recent paper, titled Our Underappreciated International Reserve System, was published by the National Bureau of Economic Research. Great to have you both here. Welcome to the podcast. So I did a podcast last year, not so long ago, with Ken Rogoff, whom you both know, I'm sure, about his book called Our Dollar, Your Problem, where he talks about essentially the arrogance of the U.S. in the early 70s when they blew up the gold standard and cleared the way for dollar dominance, and the rest is history, as they say. But your research suggests that things may finally be shifting, at least to some degree. How significant are those indications that the dollar may be losing its grip?
There are mild indications in the data that the dollar's grip may be loosening, but there is a lot of chatter around the dollar of a sort that we haven't seen since the 1970s. And I think even more concern is being expressed in global circles than was expressed then. So U.S. economic and financial policy was volatile in the 1970s, but it eventually settled down again. And we will have to see whether the current volatility is a passing phase or not.
And Chima, I mean, from the IMF perspective, how do you see this?
Well, I think the changes that we've been looking at in the use of the dollar as a reserve asset are very gradual. So I think that's something that maybe gives us a bit of comfort, because these changes affect asset prices in very important financial markets, and people don't want to see abrupt shifts from one set of currencies to another. So, I mean, you're saying that these indicators are small, but do you think it's the first signs of a declining role for the dollar in the global economy? Or is it just another somewhat perplexing trend in a very confusing economy?
From my perspective, it is an indication that the dollar is very gradually losing its dominance in the global monetary and financial system. So we see that in the currency composition of foreign exchange reserves, where the dollar's share of allocated or identified reserves has fallen from a bit more than 70% of the global total at the beginning of this century to a bit less than 60% now. We see it in the share of U.S. Treasury securities that are held by foreign central banks around the world, which has also been falling in recent years. Other indicators haven't followed, but I think we know that the different functions of a international currency are interrelated, that they complement with one another. So my own forecast would be where the dollar's share of reserves and where the foreign central bank share of U.S. Treasury securities has led, the other functions will eventually follow.
So at some point in your research, you suggest that the small decline that you've picked up on, in part at least, is due to some competition from other currencies outside of the so-called Big Four. You know, the dollar, the yen, the euro, the pound, the British pound. So, are there, in your opinion, any realistic alternatives to the dollar at this point?
So the facts first. The currencies of the other two big economies, other than the United States, the euro area and China, have basically gained no market share in terms of share of global foreign exchange reserves. 3/4 of the market share that the dollar has lost has been gained by these non-traditional reserve currencies of small, open, well-managed economies. Over the quarter century, the Chinese renminbi had gained a bit of ground, but what's striking is that in the last 2 or 3 years, it has lost global market share in terms of reserves to the Australian dollar, the Canadian dollar, the South Korean won, 3 of the non-traditional reserve currencies whose role we identified. And I think that makes sense, that these currencies of small issuers are easier to buy, sell, hold, and trade. You know, we all carry in our pockets a device, a cell phone, where we can trade currencies. So bid-ask spreads on these non-traditional reserve currencies have come down over the years to the same neighborhood as those on the big currencies. All that said, these are small economies compared to the United States. They can't substitute for the dollar at scale. They can usefully supplement other sources of global liquidity, but they lack the size, they lack the scale to substitute for the dollar, if that's what you're asking, Bruce.
Yeah. And Chima, I mean, I'm interested in hearing, the perspective from you guys who track and monitor currencies and work very closely with central banks. Is there anything out of your research that may have, raised eyebrows in terms of what central banks are holding or trends that you may have indicated in your working paper?
Yes, I think, as Barry was mentioning, I think people would be surprised that if we identify a fall in the share of the role of the dollar in the international financial system, you would expect kind of bigger economies such as the Eurozone or the China to kind of fill that gap. So I think it's surprising to people to see that the shift has been into smaller currencies that, as Barry said, don't have the same scale and liquidity as dollar assets and the U.S. Treasuries, for example. And so there's a bit of a tension there from our perspective, because there are only a certain number of currencies which are eligible as international reserves. International reserves have to be available during tough times when asset prices could be moving very quickly, when you have a global downturn, and not every currency maintains its value in those more turbulent situations. So, to the extent that reserves are being shifted into these small, well-run economies, like the Canadian dollar, Australian dollar, Korean won, there's not so much concern, I think, but we do have to keep an eye on what else are central banks or other institutions that do similar things to central banks in terms of holding foreign assets. Where are they putting their money?
Bruce, if I can add 2 other things that I was struck by. Number one, in terms of the dollar's role, we find an important role for political alignment with the United States, as well as economic links. So some of the standard stories in the literature point variables like how much does a country trade with the U.S., how tight are its financial relationships with the U.S., and we confirm that those things still matter for countries' reliance on dollar reserves. But in addition, political alignment measured by things like whether countries vote the same way in the United Nations General Assembly seems to matter as well. And that's potentially important in a world where geoeconomics matter more, where people talk about competing economic and political blocs, one perhaps centered on the U.S., one perhaps centered on China. The other thing we find is that the demand for gold depends, as people have written before, on the standard economic variables, how much global economic and financial volatility there is, whether a country has a flexible exchange rate regime so it can lock up more of its reserves in gold. Yeah. But in addition to that, we find that U.S. financial sanctions matter, and that it's not only the case of Russia, but more generally, countries that have been on the receiving end of U.S. sanctions have tended to shift more of their reserves in the direction of gold.
You just said a lot. So I'm going to back up a little bit here. So I was going to say that in your working paper, as I was reading through your working paper, there were things that jumped out at me. And one was this idea that the renminbi, wriggling its way into the reserves world somehow, for me, was a surprise. But the other was gold. And you just touched upon that. And how central banks are essentially buying up gold again. So let's start with gold. What is that about? Like, how did that start?
Well, it started historically, of course, as, central banks have a long history of holding gold. And advanced country central banks inherited quite a bit of gold reserves from the past, from their gold standard days and their Bretton Woods days. So advanced country central banks are not the ones who've been buying. It's the central banks of emerging markets and developing countries, which typically did not inherit large amounts of gold from the past. So they are like portfolio managers everywhere, seeking diversification. And one way they can diversify is to add a commodity play, if you will, to their investment portfolios. And the respectable commodity for central banks to hold, given that history, is gold. Gold is traded in a relatively liquid market in London, so that's another advantage of choosing that particular commodity when you want to add that commodity play. And gold is safe when vaulted at home. So I think those are among the motives that we are seeing play out.
And Chima, I mean, you also talk about how some countries are going as far as repatriating the gold from the Federal Reserve Bank in Bank of New York. So is there really a huge vault of gold in New York?
Yeah, so I mean, a lot of countries are still holding quite large amounts of gold at the New York Federal Reserve. But we can point to individual countries that have either publicly stated or more quietly made a decision to repatriate some or all of that gold, not just from New York, but from London as well. What's interesting is that when we look at those countries, it's not only the emerging market developing economies that may be targets of financial sanctions that we focus on as the main buyers of gold recently. But you also see some advanced economies, and particularly in Europe, that are doing the same, perhaps for more political reasons, like domestic political concerns.
So, Bruce, I would add that if you are fortunate enough to visit the Federal Reserve Bank of New York, one of the officers, in other words, a senior economist, can take you down to the basement, and you are able to see the cages that contain the gold of foreign central banks and others. It's quite a sight. But I agree with what Chima said before. Some central banks are bringing their gold back home to keep it safe, free from potential sanctions. But other central banks do so simply as an expression of national sovereignty. So we see that there has been popular pressure in France, popular pressure in the Netherlands, popular pressure in Germany to bring back home gold previously vaulted in London or New York, simply in reflecting the feeling that this is part of the national patrimony and we should keep it at home.
So you made this sort of link between sanctions and the gold. How does that work? Like, why would Russia, for example, have more gold than U.S. dollars?
So Russia basically doubled the share of gold in its total foreign reserves between 2014, its annexation of Crimea, and 2022, when its war with Ukraine broke out. In 2022, a coalition of other countries, mainly Western countries, froze Russia's bank deposits and security holdings in the West, but couldn't freeze Russia's gold because Russia had brought that gold back home to Moscow and St. Petersburg.
It's a way of getting around sanctions. If they're not holding U.S. dollars, or the impact of sanctions is diminished tremendously then.
Right, but it also diminishes the liquidity of those foreign reserves. So the other thing you learn when you go down to the basement of the Federal Reserve Bank of New York is how heavy a bar of gold is. They play a trick on you where you walk over to one loose bar sitting on a table and they say, pick that up, and it's almost impossible for someone of my size to do. Gold is awkward for use in cross-border payments. There is a famous story of a certain South American country buying oil field services from a certain country in the Middle East and paying for those services with gold. The purchaser of the oil field services had to hire a fleet of 747s to transport the gold bars.
Oh, my God.
If I could just add a point to this as well. I think that your question also comes back to the lack of realistic alternatives to holding a large share of your reserves in the dollar. So if we look just amongst currencies, if you're facing financial sanctions in the dollar, there's a good chance you'll be facing them in other major currencies as well because of the system of alliances between the issuers of these currencies. So I think the move into gold is also an expression of that inability to avoid financial sanctions amongst the major reserve currencies.
Okay, so a country like Russia has its reasons for not holding too much U.S. dollars, given the sanction issue, but they have also been buying up. This is one thing that I was surprised to read in your working paper, that, they bought up renminbi to the point where they essentially hold most of the renminbi on the market that's available on the market. So given that the renminbi has had its moment, as we sort of touched upon a little earlier, what are the chances that it ever does become a real contender as a reserve currency, given its closed banking system?
So the first rule of forecasting is give them a forecast or give them a date. So if you do not, never give them both. If you don't press me for a date, I would say the chances are good that the renminbi, given enough time, can become a consequential international and reserve currency. China is a large economy. It has been moving on a variety of policy fronts to try to foster international use of its currency, from building a correspondent banking platform, the cross-border interbank payments system, to having its central bank extend swap lines to renminbi swap lines to foreign central banks, a variety of other measures. So it's putting the relevant infrastructure in place. You're right, Bruce, that to the extent that its markets are not completely accessible due to financial capital controls, that increases the difficulty. There's an element of regulatory arbitrariness that may discourage foreign users. And I think there's also an issue of transparency and so forth. The People's Bank of China is not an independent central bank. And I think central bank independence is one important foundation stone for a leading international and reserve currency. So that issue bears on China. It bears, as we speak, also on the United States and the dollar.
And Chima, I'm also interested in hearing your perspective on this in terms of, how the international financial institutions are watching the renminbi. I mean, the IMF brought it into the SDR basket not that long ago.
Right.
There's obviously some interest there. What's your take?
Yeah, so I would say the inclusion of the renminbi in the SDR was a recognition of the increasing role of the Chinese economy and the world economy, its role for many countries as a trade partner and as a destination for foreign investment. And so I think what we see now is a bit of a disconnect between the size of China's role in the economy and its use as a reserve currency and a currency in other functions. So that's something that's been highlighted by our research department in the 2025 external sector report. And so, we would expect if things just stay the same, that there should be some increase in the use of the renminbi as a reserve currency. And in our work, more specifically, we do see that even though the share of the renminbi at the moment is quite small in global reserves, there are initiatives like increasing the share of trade with other countries or providing currency liquidity to other central banks or in the form of swaps that do have a positive impact on the share of renminbi in a country's reserves. So, we haven't seen a huge impact yet, but we can measure the effectiveness of these policies.
So we've not yet talked about the dollar's so-called safe haven status. So what is that exactly, and how does it play into the dollar maintaining its dominance, even when at this point there are pretty clear signs that much of the world would rather it not?
So traditionally, the dollar has been a safe haven in the sense that people rush into it when there is a spike in global volatility. And people rush into the dollar even when the United States is responsible for that spike in global volatility, as it was, for example, back in 2008 with the failure of the investment bank Lehman Brothers. That's a long-established historical pattern, and I think it reflects the fact that U.S. policies have always been, broadly speaking, sound and stable, and the market in U.S. Treasury securities, which is where these international investors rush into specifically, is the single largest and most liquid market in the world. And liquidity is valued. It's at a premium when in uncertain times when the global economy and financial markets are volatile. So that's how I understand that notion of the dollar as a safe haven. That behavior, global volatility spikes, and the dollar strengthens was not evident immediately after Liberation Day, April 2nd, 2025. So people began to wonder whether that safe haven status was still intact. The conventional pattern kind of reasserted itself after 6 months or so. And in the 2 days after war in the Gulf broke out, first two trading days, March 2nd and 3rd, the dollar strengthened against the other major currencies by about 1.5 percentage points. So is that an indication that that safe haven status is intact? The dollar moved in the requisite direction, but given the magnitude of the shock, should it have moved by more? And the fact that it didn't may be an indication that investors, at least some of them, are having second thoughts. It's too early to tell.
And just finally, I mean, the markets don't seem to be. I mean, Barry, you mentioned after Liberation Day, and people were closely watching that, and markets were reacting. But it seems, at least to me, that the markets are not reflecting this sentiment about whether or not the dollar should maintain its dominance in the global economy. Am I wrong about that?
So there are some indications, for example, what people refer to as the convenience yield on U.S. Treasury securities seems to have withered and all but disappeared. Convenience yield means that people are willing to hold U.S. Treasury securities at a lower interest rate or lower yield than other securities with an adjustment for exchange rate risk and so forth. So that convenience yield in the past has been noticeable. At the moment, it no longer is. So the markets may be waking up to the fact that there are changes in the international monetary landscape. But I think what you point to, Bruce, is a more general disconnect between global economic risks, global geopolitical risks on the one hand, and markets on the other hand, that you can say the same thing, for example, about the U.S. equity market. Right. It didn't exhibit a sustained decline in response to recent geopolitical eruptions. Are the markets simply hypnotized by AI? That's possible. Do they feel like everything we've been talking about, from events in the Gulf on the one hand to events affecting the longer-term prospects of the dollar on the other hand, that these are all passing events? That's possible. Psychoanalyzing the markets is above my pay grade.
All right. Well, Barry Eichengreen, professor of economics and political science at Berkeley, and Chima Simpson-Bell, economist in the African department here at the IMF. Thanks to you both.
Thanks very much, Bruce.
Thank you.
Look for the IMF working paper on dollar dominance and the rise of non-traditional reserve currencies at imf.org. Barry Eichengreen also has a new book out on this topic. Money Beyond Borders is published by Princeton University Press. And look for other IMF podcasts on Apple Podcasts, YouTube, or wherever you listen. You can also follow us on X. Our handle is @IMF_podcast. I'm Bruce Edwards. Thanks for listening.